Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, August 18th, 4:51 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at key levels for next week, and review. We're not going to update it anymore. We're going to start something new, and that is to go through a full weekend review before updating the 21-21. We know what's getting punted off, and I want to do all my sector analysis over the weekend before I decide what's going to be the final list going into next week. So going forward, we will talk about cuts to it, and then we'll present the new 21 on Monday videos. So state of the market, mild correction. You can see over here on the trend gauge, things got worse this week. Last Friday, we downgraded leaders to bearish based, strictly on their action. We go by facts, we go by price and volume, what stocks are actually doing here at Revere. And that was a precursor to this week's downgrading of both the short term, which is the 5 major indexes versus their 21-day moving average, and the medium term, which is the 5 index versus their 50-day moving average, downgraded to the dreaded red arrow, bearish/downtrend. On the plus side, and this is a plus side because the market doesn't get into serious trouble unless the indexes, and we focus on the S&P and the Nasdaq, unless they break their 200-day moving average. All 5 are still above there. We had a couple bounce at that level. That was how bad the deterioration was this week, that we went from not even discussing it, what was getting close to it, to undercutting and reclaiming it. So today was the day for that. And we'll take a look at the chart. So what just happened today? Well, I alluded to it in last night's video, forgot to break it down in detail, but we discussed it more before the open at the S&P. When it was looking like it was going to gap down, it was bottoming right above actually 8 different technical support levels, all stacked within a 1% range. Pretty interesting. Don't see that a lot. As you know, the more levels or reasons there are for support, the stronger that support is. So after 3 tough down days in the market, Tuesday, Wednesday, Thursday, to have a gap down on day 4, well, you're almost set up for a positive move to the upside. That's what we're looking for. That's what we got. And we'll discuss those levels when I do the tail of the tape after we take a look at the charts. So bottom line, today we stopped going down because the market went into correction. This is O'Neill rally day 1. So I've been alluding to this week. That's part of our process. After a bottom is put in, you look for a follow through day, which is a strong move in the indexes on day 4 through day 7, ideally off the low, as well as leading stocks breaking out of bases or bouncing at support levels. So that's what we're on the lookout for next week. Here are the final numbers for the indexes. The RG8, our 8 growth ETF, up 0.4%. S&P just barely closing negative after being down, gapping down 0.7%, but putting the low in basically immediately. It got to positive by 0.2% within the last 15 minutes, but sold off a bit into the close. But you got to stop going down before you can start going up. I know that's kind of obvious, but got to apply the brakes to the downside before we can start repairing the damage. NASDAQ 100 also trying to put in a bottom. It was down more than 1% after gapping down 0.8 at one point. But big positive reversal of a lot of the big 7, particularly NVIDIA, which was down over 3% at one point. NASDAQ 100 down 0.13, Dow positive by 1/10%, mid caps positive by 0.3, Russell 2000 positive by 0.5%, global diversified 60/40 up 0.10, global stocks down slightly, but bonds finally interest rates stopped raising and the prices got a little bit of a pop today. Up 0.1%, in-house GROTECTION just barely positive. We'll hit the tail of the tape and the 21 over 21, but let's get into the indexes first. So you can see here the S&P 500. Let's go to a 5-minute chart. Here's your gap down, and immediately in the first 5-minute bar here, put in the bottom at 43.35, trended higher for a few hours, put in basically a cup and handle base, tried to break out here at 345, got above 43.80, and then faded into the close. But all in all, a win for the Bulls from the standpoint, or let's just say that not a win for the Bears. That might be better, but looking like the first attempt to put in a bottom. So why am I somewhat more excited by this than I was the prior couple of days for putting in a bottom? Well, there's a couple of reasons, and they're all technical related. So let's discuss them. Uh, let's go to the 21 over 21 very quickly, because what we're really focused on is these 3 lines here. There are 8 technical levels. They're all basically within a percent. We'll start at the top and we'll go lower. So the first one is 43.44 on the S&P 500. This is from a key fib level. If you're not aware of what Fibonacci levels are, you'll have to Google it. I'm not going to break it down here, but there are levels that occur between key lows and key highs, and they're centered around the Fibonacci ratio, the golden ratio, and the key levels within there. And this right down to there is a 23.6 pullback from the low to the high during this period. So that's actually right about in here. It is the 43.44 level, which we undercut and reclaimed today. So that's level number 1. Level number 2, and we're working our way backwards, is 43.28. This is both the -3 ATR from the 21-day moving average, and it is also the August 22nd high. So that is, sorry, the August of 2022 high. I got to get this a little bit larger here. It's the close, actually. I'm sorry. It's the high from this date here back last August. 43.25, 43.28-ish. So that is the second level. Let's go back to the 21 over 21 here, August 22 high, SPX -3 ATR. So that's 3 levels. That's the 28th and the 25th. Let's see, June of 23 pullback low. That is, one second as I flip back and forth between. So the June low is right here. This is June 26th. The low was 43.28. So that's the 43.28 level. 43.25 over here was back last August. So that's 4 levels. Level number 5 is 43.12. That is the entire bear market. So basically from here to here, let's draw a line. From here to here, this level is the 61.8 retracement level. 61.8 and 38.2 are very key fib levels. And we pull back and bounced, or we would have bounced if we hit it right about that level. But that's one of the 8 technical levels right around this area below here. And let's see what else we got. 43.12. That is actually, it's 4300. 43.12 is the fib level. 4300 is this resistance area right here before we were able to break out on this latest move higher. So that's number 7 and number 8. Actually, that's number 6. Number 7 and number 8 are the 20-week moving average, which is 43.17. That's in this area here, and 42.97 is the 100-day moving average. Let me turn this on moving averages, and you'll see the 8 isn't doesn't mean a whole lot relative to where the indexes are right now. But you can see here, if we turn track price back on, 42.97 is the 100-day moving average. If you go on the weekly, the 20-week moving average, 43.16. So it's actually 43.16. So that's a big level of technical support right below where we bounced today. The first level being actually an undercut and reclaim at 43.44. So that gives us a little bit more confidence in this gap down in the bottom that's put in. No guarantee, nothing is ever a guarantee in the markets, but think of it as the difference between having one support level, maybe a 1/4 inch thick board that you can jump on and very easily break, and 8 1/4 inch boards stacked one above another, which would be a 2 inch thick board, which would be much more difficult to break. So that's kind of how we're going to look at it here, that if we get into this level, we're expecting it to hold. If it doesn't hold, well, that's part of the market. There are no certainties, but what we do is weigh the scenarios and the possibilities or probabilities, as well as what our expectation is. And the fact that we had a really strong move down this week, our expectation with us being so extended to the downside is that we're going to bounce at some point, and this was a very logical bounce at a very above a very strong support level. So that's our take from the action and the various technical levels, and that's what we're going to be watching going into next week, because this, after all, is the big show. Let's move on to the NASDAQ 100. Uh, there's a couple of technical levels in here. We put more weight on the S&P 500 because of how of all the rotation that takes place. It's a broader index. It reflects different sectors more appropriately than a very tech-heavy index like the NASDAQ 100, but very similar bar put in today. After on the fourth down day, you had after 3 down days a gap down on the fourth day. We actually made a lower low. The NASDAQ 100 was extremely weak early. I mentioned in the video, we'll show that chart here in a minute when we talk about the portfolio, but you can see this trended higher, and in fact the strength came in because this made a higher high in the early afternoon while the S&P 500 didn't. So we went from relative weakness in the morning to relative strength in the afternoon, maybe saying that we've just gone down far enough in this very short period of time on the NASDAQ 100. And what we'll do, what line drawers do, we put a line in the sand below today's lows. And if we break it, then it means something. And we look for the next levels down, which are several of them between this 100-day moving average and today's lows. Next up, Dow Jones Industrial Average, second close below the 50-day moving average. Want to get back above this 34.6 breakout level. We're close to it, 34,500. That'll take us back above the 50-day moving average next week also. We also want to see the relative strength start to wane on because we know that it outperforms when markets are pulling back because it's a defensive index. And we want to see this, frankly, we want to see this relative strength stop so that we can get, because we know it's growth stocks that will really outperform the market, not the Dow Jones Industrial Average, and we're looking to outperform. Let's go to mid caps now, the MDY index, and it bounced at the 100-day moving average. Right below there is the 200-day moving average, 3 closes below and a weekly close below the 50-day moving average. But again, putting in the bottom at 100-day moving average and actually finishing positive on the day. Let's go to small caps. Actually undercut the 100 and the 200-day moving average, which are basically right on top of each other, and a positive close. So gap down, uh, positive close. Again, another attempt to put in a bottom. So that's our take on the major indexes. Let's go to the other tickers for the inter-asset correlation that we do. The VIX also found resistance at a key level, the 200-day moving average. Closed inside yesterday's range, which is a positive divergence because the market, the S&P, didn't make significant inroads into yesterday's range. So uh, still above all the other moving averages with the exception of the 200-day moving average, which is bearish, but we want to see it get back. Basically, we want to see it break back below this consolidation level here, especially get back below 15 and see the market recovery. And that's what should happen if the market recovery starts to kick in. Let's flip over to the dollar. Very tight range for the dollar today, continuing this strong up move. Bulls want to see this pullback as a weaker dollar is overall considered better for stocks. Let's compare this to uh, gold stocks, which were down 0.6% today, making a lower low. It's got to obey your stops on these, no matter what you think about gold or precious metals. GLD basically flat inside day today, below the 200-day moving average. SLV up 0.3%, trying to obeying the bottom of the 3 days prior this week. Let's look at Bitcoin, which really fell apart. Massive gap down. This really started at 6 o'clock last night on the regular Bitcoin exchange, carried over to this what the trading on the index is, the Bitcoin future ETF. You can see the big gap down here. So this tight consolidation broke yesterday, really fell apart today. Let's flip over to bonds, BND. A little bit of a bounce after 6 days down. Will the bottom hold? Well, if the bottom holds and we go there, we're gonna expect stocks to do exactly the same because that means interest rates are going to be pulling back. That's good for the growth names that we traffic in because uh, we know from history that growth stocks in a strong bull market will far outperform the indexes. So there's BND. Here's TLT, the long bond. A little bit of a bounce there also. Let's go to the yield TYX. First pullback after making new highs going back to October of last year. The 10-year TNX pullback after making highs going back to October of last year. And that is all of the inner asset correlation that we do in every one of these videos. So let's go to the tail of the tape now. Mild correction, as we've already said. We're operating under the bear case with the failed rally and the break below the 21 EMA. Some news that led to the gap down in the morning. China, Evergrande, a $19 billion real estate developer, filed bankruptcy overnight, and that certainly contributed to the gap down in the indexes. From a day count, we went from a 12-day downtrend to O'Neill Rally Day 1. So ORD1 is what we're showing here now, and now we look for a follow-through day in days 4 to 7, along with properly set up leading stocks to put money into. 13 days below the 80 MA, that's a lot. So reversion to the mean is expected there pretty soon. 9 days below the 21-day moving average. We held support on the S&P and the NASDAQ and bounced. You can see the intraday action. As far as sectors go, oils, staples, and utilities were the standout today. GDX gold stocks and the Bitcoin complex was the standout loser. We're down to SSO, 31% SSO, 3% NVIDIA, 1% NVDL. No changes in the portfolio today. So our beta still at 0.78 with us below the 50-day moving average. We've got a target ceiling of 1.0 for our portfolio exposure. And the bottom line, O'Neill Rally Day 1 as the S&P finds support above an 8 technical level confluence in a 1% range. So thick floor. Let's see if we can obey that. If not, then the market is even weaker than the weak action this week would suggest. So let's first of all take a look at the NVIDIA uh, 5-minute chart. Big gap down, and then what just looks like everybody heading for the exits that wanted to. Look at the big volume here. And then it stopped going down. So while the indexes recovered immediately, NASDAQ or NVIDIA had a huge volume sell off. This is people saying, get me out. I've had enough. It coincides with a break back below the 50-day moving average, which certainly you wanted to obey after recovering it with the strong action on Monday and Tuesday in NVIDIA. But really good action the rest of the day. You can see it also making higher highs late afternoon and near the close, the way the NASDAQ 100 did. And this is a line in the sand for NVIDIA. We didn't get shaken out because of how sparse our other positions were. We stayed in line with the market, which is basically what we're trying to do now, is tread water in the market before we can start swimming with catching a wave, jumping on the surfboard and see if we can ride that wave again. But the wave hasn't shown up yet. So for now, we're basically just sitting on our surfboard, paddling, treading water, whatever metaphor you want to use. So uh, that's NVIDIA. And then our other big allocation is the S&P 500, waiting for the sector rotation and the rotation from value to growth to finish playing out within there. And then we'll see where that takes us. So let's get to the 21 over 21 now. And first, we'll talk about the 7 names that got booted out for poor performance this week. We'll start off with Boeing. Uh, you know, when the market's pulling back, stocks are going to pull back. 75% of them are anyway. They're going to go with the direction of the market. This has been a hard pullback market. We had a nice gap up. There's nothing wrong with Boeing right here. It bounced at the 50-day moving average, but this isn't the 50 over 50 list. This is the 21 over 21 list. So we'll keep this on our list as a healthy bounce off the 50-day, but it's off the 21 over 21 list. Elf, another one, big breakdown yesterday. Definitely a change in character. Bounced at the 50-day today, just where we would want it to. So again, coming off the 21 list, but certainly staying on our watch list because it bounced that key 50-day moving average. VICR, big disappointment here after a 50% up move, just continuing to bleed lower. It's still above the 50-day, but very clearly has given back almost all of the gains from its earnings gap up. So that's number 3. BWXT, just barely closing below the 21, but again, bounced at the 50-day. Had a great reaction to earnings, so we'll keep it on our universe list, but not on our focus list. Our focus list is the 21 over 21. EXTR, big leader in networking for a while, failed at the 21, bounced at the 50-day, goes to the universe list from the focus list. That's 5 stocks. And then 2 that we got stopped out of this week, Bros, after its big earnings gap up on huge volume, pulling back, closing below the 21, holding the 50-day, back below the 200-day moving average, gave up most of the move. Disappointing, but on lighter volume, remembering how big the volume was on the earnings gap up day. So it goes to the universe list off the focus list. And finally, Amazon, which we got stopped out of in 2 tranches this week as it broke below the 21-day moving average, but it bounced at the 50-day. Very common for stocks to pull back to the 50-day moving average, and we'll see if it coincides with the market putting in a bottom. It's very likely that these stocks have put in a bottom too. So those are the 7 that got punted off. 1 stock added for sure, and let's get to the 21. And right now it's the 15 over 21 list. And we'll start with a coal stock. Michael did a great breakdown on this in the podcast today. Make sure you check this out. From a fundamental standpoint, an amazing opportunity here. It's a bit on the thin side. We could take a small position if we got a good entry point, but check out the podcast to see Mike's fundamental breakdown on this. So these 14 carry over from last week, which means the market hasn't totally fallen apart. And AAOI, very volatile, but holding the 21. Eli Lilly, higher highs after its gap up. Not a lot of stocks have done that over the last couple of weeks. This one has. NVO consolidating after its big news of its move up on its Wegovy drug, also fighting cardiovascular events. AppLovin, it's above where it gapped up on earnings. Again, rare to see that, so we're isolating the strength here. Celsius, basically where it closed on its big earnings gap up. Axon bounced at the 50 and the 21 after pulling back after its earnings gap up. Still inside the base though. Now something that goes up when real estate goes down. DRV above the 21 because real estate is in a bearish market. NRGU oil stocks continue to just act great above the 21 here. Bunge agricultural operations pulling back after earnings, bouncing at the 21. Cheniere Energy LNG undercut early in the week, reclaimed the 21 by the close. VRT, we sold this yesterday on general market weakness and a break of the ADMA. It bounced 3% today. Definitely one of the strongest stocks. And you're seeing a lot of things in common here, and that's these earnings gaps up. And we know that they provide alpha going forward. So that's why we've got them on the list. TBT goes up as interest rates go up, so it's a good hedge for the market. First day of a pullback here after making new highs. TDW undercut reclaimed the 21 EMA, leading oil stock after a shakeout on its earnings report. And finally, Weatherford bounced at the 21, another leading oil stock. And that is your 15 over 21 list. Join me on Monday and we'll go over the other 6 that make it into the 21 over 21 for next week. And with that, we're going to wrap it up. As always, love to hear from you. My email is don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Love to hear from you. Or you can email my partner, Dan Stewart, dan@revereasset.com if you're interested in getting information about becoming a client. Remember, it's not how much you make in the markets, it's how much of that you can keep. Our flagship portfolio is called GROTECTION. It's designed to grow assets when the market is in our favor and protect them when the market turns risky. And the market has been in a risky or negative or bearish posture over the short and medium term over the last couple of weeks. So right now we're in protection capital. Market stops going down. We've got a great list of stocks to focus on if the market wants to resume its uptrend. If not, we're prepared to wait until it does. And with that, we will wrap up the Revere Market Insight Video Big Show for the week ending August 18th. This is Don Vandenbord with Revere Asset, telling it like it is. Not necessarily the news that you want to hear, but it's the news you need to hear about what's going on in the markets. Thanks for listening and have a great weekend.